So one of the common questions we get is what percentage you should have in your portfolio in Bitcoin and other digital assets. That's a kind of complex question, but I'll try and cover it. The Because it really varies a lot on your situation, but I can give you some broad rules of thumb that might help you depending whatever your situation is. The first thing that you need in your investment process is a plan. As the old saying goes, if you don't know where you're going, you just might get there. If you don't have a map to where you're going, you'll get wherever the world ends up driving you. It's hard enough with a plan to make a plan, but if you don't have a plan, you have really no prayer of accomplishing the goals in the plan, unless it's just sheer dumb luck. So you really need a plan first, and the plan should include, at the very base, a snapshot of where you are and what your situation is, how much money you have, and where it is. And then you want to be thinking about what your risk tolerance is, what your time horizon is, and what your overall investment plan is. And then once all that is done, which doesn't necessarily take that long, it can take weeks or months or even years and hundreds of hours in very complex cases, but you could get the basics done and probably be ahead of most of your peer group with just a little bit of work, maybe a couple hours, just to even think about that basic kind of plan or roadmap about where you want to be. After that piece is done, then the asset allocation part of it is very important. We talked about the asset allocation, which is sort of your pie chart of where all your money is. How much is in cash? How much is in digital cash, currencies, stocks, bonds, real estate? What else do you own? Do you own a piece of a business? All of these kind of things should be considered because they're all part of your overall portfolio. Now, most people in the crypto space are actually quite a bit overweighted in Bitcoin. Or overrated in crypto because of the way that the assets grew very rapidly. There's a lot of people who ended up with a lot more of it, and then that sort of self-corrected with the crash, especially in altcoins and a lot of the other assets were down. Even Bitcoin was down. So most of the people in the world tend to be either really underweighted or really overweighted in digital assets. And I also want to separate Bitcoin with digital assets and the different types of digital assets because they are absolutely not equal. They're very, very, very different things. You don't just want to make the mistake of saying, okay, I'm going to have an allocation to crypto, and you end up buying one of these tokens or something which may be a low quality product, and you may end up losing all your money. I mean, the worst is people who had exposure to crypto, kind of crypto as an overall class, but they didn't have exposure to the assets that went up like Bitcoin. That would be a real shame if somebody put their life savings in this general space, but ended up losing money anyway, even when it went up, quite rapidly during its good periods. So what you want to do is have an overall plan, and in general, and it really, really varies quite a bit, but in general, for a normal financial plan for either an individual or an institution, very rarely would we have a really huge allocation to digital assets, including Bitcoin. You might have, kind of maximum 10% or something like that. I know that's going to be hard. Now, I have a lot of people that I advise who are good friends of mine who made huge fortunes in crypto. So they just end up with 99% of their money in crypto because that's just the way that fate was. But the plan, if you're in that situation, and it doesn't have to be huge money, because it's huge money for you, percentage-wise, is what we're talking about, is you want to diversify that out. A lot of people during sort of the peak, with crypto during the run-up, a lot of people took money off the table, invested in other traditional assets. That was a wise move. Real estate, things like that. Your base of your portfolio should include cash first, cash above all else, and that cash can be Bitcoin for you. Bitcoin is my preferred version of cash. I have some other kinds of cash too, like some fiat, but maybe you don't like Bitcoin at all. That's fine, but you want to have some piece that is cash, liquid type investments, so that you can cover fiat-based expenses and that you have you have that as a base. Now, Bitcoin is a little bit different because it's both cash, but it's also a speculative asset. And make no mistake, it is very speculative. It could go down Very, very radically. It is not a proven thing. I love Bitcoin and I hope it does well. But the thing is, I could even be right about the technology, and it still doesn't matter. The best technology doesn't always win. So it is speculative. It's certainly not a sure thing. Either way, you also want to have a piece of your portfolio be equities, stocks, because businesses have historically built wealth better than almost anything else over time. Businesses and commerce and entrepreneurship is what drives growth and revenue and income. And in the old days, the landowners, the lords and things like that, they measured their wealth in income. What is the income you get from all these different fields? Income is really important, and stocks are a great way to get income because businesses make money, and that's what stocks are. They're a piece of a business. And the greatest, success stories, whether it's Google, Facebook, Microsoft, they're stocks. So having a participation in that makes sense. Now, some digital assets are going to be stocks. Stocks also include startups, venture capital. There's all different kinds of things that can be more risky, less risky. You want a portfolio within the portfolio. So within the stock piece, you'd want something that tells which stocks you have and how that portfolio is, whether you have large cap, growth, small cap value, how these things interact. And then the other big piece of your portfolio should be real estate. You should have some kind of real estate. Maybe your home, maybe something else. Ideally, if you have from an investment standpoint, the best is to have real estate that you can earn a return on. And real estate is a specialized thing. You need to know what you're doing to do it. It's a little bit easier than some of these other things. But in general, the best with most of these areas is to trust it to a professional. If you can, and for as little as $1,000, you can get an allocation to real estate through a fund where you're going to have much more diversification. You have a professional team. They're out there deciding what buildings to buy, and you're going to have more diversification and a lot of other things. There's going to be high fees on that. Real estate investment trusts and things like that tend to have higher fees, but you also get more diversification. So there's a lot of ways to do that. But back to the digital assets piece, some of these other things, like even real estate and certainly stocks, are going to be digital assets. And then you have currencies, which I already mentioned. You want to figure out what piece of your portfolio should be cash and what cash is for you. Is it Bitcoin? Is it the dollar? Is it something else? I'd probably recommend having it, let's face it, no matter how much we love Bitcoin, fiat is still the dominant currency. So some portion of your portfolio, usually people denominate the portfolio in fiat of their own country as well. But generally, most people who don't own crypto assets are very underweighted. If you don't own any crypto assets and you have a growth-oriented portfolio, and again, this advice is very broad. It really depends on your situation. You should talk to a financial advisor. But in general, if you're growth-oriented, meaning your goal is to grow the portfolio over time, and you have a long time horizon and you can afford risk, take a piece of what you can afford to lose, and you could put that into Bitcoin and other cryptocurrencies. For digital assets like stocks or securities tokens, you want to analyze those the same as you would any other stock. Some are going to be junk, some are going to be good. Being a digital asset, being a token doesn't mean it's good, doesn't mean it's bad. It does probably mean that it's more likely to attract a higher risk and lower quality product. So most of them are going to be junk. So you want to be even more careful. But certainly don't think that just because something is a digital asset, it's a good asset. You want to use prudent, smart investing strategy and have a diversified portfolio of the digital, stocks or whatever digital assets they are. And then I already mentioned real estate. So that's just something to think about in your, how the percentage of what Bitcoin and other digital assets you have fits into your portfolio overall based on your asset allocation.